And ladies and gentlemen, thank you for joining today's webinar, Elderlaw Crisis Management and Life Care Funding, a Successful Case Study, Funding Long-Term Care, discussing how it was done with real-life case study examples from attorney Randy Clinkscales. It's our pleasure to have attorney Clinkscales join us today for this session. What we'd like to do is just remind folks of how the Life Care Funding Long-Term Care Benefit Program works, and then invite attorney Clinkscales to talk with us through a couple of recent case studies where they have used the program successfully with clients to address their financial and long-term care funding needs. And then we want to open up to anybody's questions, and with the GoToMeeting platform, the way to address your questions to us is in writing in the questions field, and as they come in, we'll go through them and field questions that are either about the program that I address or specific to the case studies that Randy could address after he's done talking about those case studies. But by way of beginning, I am Chris Orestes, CEO of Life Care Funding. A pleasure to have you all with us today, and I'll just remind you, as Life Care Funding is approaching its 10th year now, we specialize in converting the death benefit of an in-force life insurance policy into what is known around the country now and accepted as a funding tool for long-term care, a long-term care benefit plan, which will cover any form of care that a person would want to choose, whether it's home care, assisted living, skilled nursing home care, hospice care, anything will qualify to be paid for by the long-term care benefit plan. And as a quick reminder, converting a life insurance policy means that the owner of that policy is going to be selling the policy for a percentage of the death benefit. The typical range is 30 to 60% of the death benefit. The average tends to be about 45%. We've seen over the years, when you look at all of the cases and enrollments we've done, it's about 45% of the death benefit. Any kind of life insurance policy will qualify, whether it's a term life policy, whole life, universal life, group life, variable life. Any form of life insurance will qualify as long as there is a minimum death benefit of $50,000 and above, and an immediate need for care. And let me emphasize the importance of that. This is a program that's designed to address an immediate need for care, and one of the reasons why we called today's session Elderlaw Crisis Management, because people that are using this program as a way to fund care are not doing it because they're planning 5 or 10 years in advance. They're doing it because they need care now. They're in a financial and or healthcare crisis situation that they're trying to address. And one of the assets they have to work with, and sometimes the only asset they have to work with, is a life insurance policy. Now, the process is designed to move quickly. The enrollment can be done in a perfect world in as little time as 30 days, but what we tell people is to plan for 60 to 90 days, about a 60 to 90 day period from application to enrollment, where funds are being paid out of the account to care. But once the process is done and the individual is enrolled in their benefit, what they're receiving is a sum of money for the sale of their life insurance policy that is being deposited into an irrevocable FDIC-insured bank account. This is a very specific and special bank account held by a Delaware chartered, nationally chartered bank and trust company that's been working for years with administering these kinds of long-term care benefit plans. The payments are automatic payments made monthly directly to the care provider, and that's the care provider of choice. Any form of care the person chooses, because obviously when they go on to this option, they're private pay. The payments, the monthly payments are adjustable and flexible, so it's important to note that if care needs change, if somebody goes from a home care environment at $1,000 a month to needing to move into an assisted living community that's going to be $3,500 a month, with a simple notice to the plan, the amount of money that's being paid out on a monthly basis and where it's going can be changed. Every one of the accounts does stay open and hold a funeral expense portion to the very end. So there is a small cash funeral expense benefit that is part of the benefit plan. And we are asked the question often, what happens if somebody dies with a balance of money in the account? Let's say they had started with $100,000 in the account, the person passed away, and there's still $50,000 unspent in the account. That is going to go to whoever has been named as the account beneficiary, which can be one or more people. Now, because the funds are being administered for somebody with chronic or even terminal care conditions, and it's being held in an irrevocable account and only used for care, the funds in the account are administered tax-free. These are tax-free funds because of how they're held and how they're administered. Also, because of the same administration and the fact that the policy as an asset is being sold for its full fair market value, this is a Medicaid qualified spend down. So somebody who would use this program would in no way jeopardize their ability to go onto Medicaid once they would have spent through the funds that are in the account. Also, last but not least, because of how this is structured, it is also a qualified spend down and a qualified benefit to be used in conjunction with the VA aid and attendance benefit, and we see many people who will use this program in conjunction with a long-term care insurance policy, in conjunction with the VA benefit, in conjunction with other assets, and oftentimes also when this is the only thing they have to work with. And this could be a significant resource to help them pay for care. Now, the market that is out there is quite large, and that's something important to note for everybody on the call. And just by example, when you think of the size of the market, I'll give you a comparison. There's about 10 million in-force long-term care insurance policies in the United States today. By comparison, there's about 100 million in-force life insurance policies in this country today. And in the hands of seniors who could potentially qualify to use this program on an annual basis, they own about $500 billion of in-force death benefit on an annual basis. Now, for those seniors, they're often confronted with the choice of keeping the policy in force or letting it go. And a very large proportion of life insurance policies that are sold in this country ultimately do not pay a death benefit, because at some point down the road, the owner either can no longer afford the premiums, or they start thinking as they get to their long-term care stage of life that in terms of Medicaid qualification, life insurance policies can be a disqualifying asset that can count against you as part of your Medicaid qualification formula. So a large number of seniors needlessly are abandoning life insurance policies by either lapsing or surrendering the policies when they don't need to, because there is alternative options such as this, to convert their life insurance policy's death benefit into a living benefit and turn it into a long-term care benefit plan, which is a protected, tax-free account that is keeping somebody private pay and putting them in a position they can choose the form of care they want using tax-free dollars in a Medicaid qualified and VA qualified spend down environment. Now, with that as an overview to open up our session, I want to turn things over to Randy Klingscales, who's been gracious enough to join us today and share with us his experience working through a couple of cases with his clients where he was able to successfully use this to address their long-term care needs. Randy, it's my pleasure to invite you to spend some time talking to us about a couple of your enrollment examples.
Thanks, Chris. This is kind of an interesting topic for me because it's been so helpful in a couple cases, one very recently and then one I think last year we did. Do you mean to start on this first one you've got here?
Correct. I think that'd be a good place to start, Randy.
All right. So kind of funny how this came up. Actually, I heard about life care funding and had spoken to Chris, and I wrote an article about it in a newsletter that goes out to healthcare professionals. And I got a phone call from the director of a nursing home about her mother. And her mother was in the nursing home, this is in Kansas. We have income producing property for Medicaid purposes. Her mother, Mary Ann, was down to about $40,000 in cash resources and her land. And so they saw a point where they were going to run out of money and apply for Medicaid. At the same time that she called right before the premium was due on a $100,000 policy, and the premium in the case was $8,500. And so they were going to drop that policy when they read the article. And so she called me, and I met with her. And in this particular case, it generated about $47,000 for the family. And the effect of that is really pretty critical, because without this money, she would have gone on Medicaid about a year and a half earlier. We would have to deal with the Medicaid lien. And so we were able to generate a monthly benefit of about $2,000 a month. That, combined with her farm income and her Social Security, basically continues to pay her away. And then we've got this other $40,000 that we'd already set aside. So we basically have delayed her going on Medicaid for at least another 18 months, plus all the Medicaid lien that would come across with that. So it was really interesting. I think from the standpoint of life care funding, I was surprised they ever called me again. We had 5 powers of attorneys on this case, and so life care funding took the ball and worked with the various agents under the powers of attorneys, and there were some family dynamics, but Chris and his folks really did a good job of dealing with that. So I'm surprised that Chris lets me do this anymore. But,
Randy, thanks for saying that. And it brings up a good point, because every situation is unique. What we have seen over so many years of doing this now is there's just never 2 situations the same. And you know this as being practitioners and advisors, whether you're elder law attorneys on today's call or advisors of some sort or another. Everybody's situation is different. The family dynamics are different. It depends on the level of crisis that's going on, how people handle it, how many people are involved. There's always some backbencher member of the family who's questioning everything everybody's doing, but not really being involved except to throw bombs from the peanut gallery into the middle of the discussion. There's always something, and we're used to it, and we expect it. And so for us, when it comes, we're just, it's say a different story, different name, but it's always something interesting, and it keeps us on our toes. That's for sure.
And Chris, I just let me add on this one and the next example that we give. To be honest with you, once the family decided to do it, I turned it over to a staff member, and the staff member and the staff from Life Care Funding really do all of it. And I really, I can give you a flyover, because I don't have to get intimately involved in how this works. So once we've made a decision to go forward with the client, there are some things they have to sign, but pretty much Life Care Funding takes over from there. So that was, it's not a lot of my attorney time.
Yeah, and by design, with our program and the way we operate, we made sure that this would be something that would not be too taxing on the families, because we know what they're going through, but also for the professionals such as yourself, because we know this is a unique circumstance. It's a unique niche. No one organization that we work with, no one law firm that we work with is doing 100 cases a year. It's a handful of cases that pop up over the course of the year. And we know this is our specialty, not yours. So when you do bring these forward, our saying used to be, we're going to do 95% of the work. We just need you to help us do 5% of the work to bring the family to us and let us then take our process through to the end and help us bring it in for a landing with the family. But we will really focus on doing the majority of that work. So thank you for pointing that out, Randy. Here's the next case example that you more recently have brought forward to the table.
Yeah, and so this one's pretty tough. This is a pretty sad story. This is a very dynamic man, very sharp, but he has very advanced MS, and he's totally wheelchair bound. He is 100% care, but he's still trying to stay at home. And he's sitting on this $100,000 term life insurance policy. I forgot to tell you the last one, I think that was a term policy as well, but this one's also another term policy. Again, sitting on it, the issue is that his wife works. They're still trying to stay at home. Their means are, they don't have a lot of means, and so being able to pay for someone to come into the home to help is really beyond what they can do. I don't know how long I'm going to be able to keep him out of assisted living or the nursing home, but they have done a lot to make this happen. And so it's really boiling down to what kind of money can I find for him. And so the life care funding is really a great option for him to consider. In this particular case, it's about $38,000 gross. We're still talking about how much we want on a monthly basis. He's at, I think the proposed plan is $836, but you know, the key is that even if it's just an hour or two a day, that we can pay somebody to come in and give her some relief. She can't leave town to go see the grandkids. I mean, he's just at that point where transportation and moving him is so terribly difficult. So it's a real good option for these folks in a very, very difficult situation, because otherwise, you know, they're going to sit on this policy and it's not going to help him at all. It's going to help her when he dies, but this is a way to access that policy now. And in a way, it's probably, to me, the more compelling case. Chris, let me add something real quick. I spoke last night at a workshop and brought up the life care funding, and my standard line when I talk about it is that if you've got somebody that's chronically ill and they've got some kind of life insurance policy, this is a way to access it. And it doesn't work for everyone, but boy, when it works, it's a really great alternative for people. And I know from my standpoint in Medicaid planning and so forth in the past, you know, we've always just kind of punted on these policies or cashed them in or whatever without having this option of life care funding. So it's an interesting tool to have in your arsenal. And in fact, I almost think it's, I always feel like it's almost mandatory now that from a, doing the best interest for my client is to, I need to bring this up. I need to look at their policies before they start dropping them. So when I was at the workshop yesterday, the point I was trying to make with people is before you drop any policies, be aware of this. And Chris, I actually have a couple slides you gave me that I put in my presentation just so that they have those slides available to them. I don't go through them item by item, but just to make them aware of what the requirements are and the benefits that are there.
Yeah, and we always make it a practice to share with everybody that works with us any materials they want to use, case studies, videos, PowerPoint slides, handouts, all of that, we make it available so it's easy for practitioners to talk about this, to incorporate into their presentations, into their information packets. So that, of course, is always available, and we know many who make good use of it, and we're glad to be able to do that. I want to just move to pointing out and reinforcing to those on the call where you're likely to be finding the right kind of people to help with this program. Again, policies with a death benefit of $50,000 and above, where there's an immediate need for care. And what we see a lot of are people that are now in that final stage of long-term care planning, or they're in crisis mode. And we do get a lot of those calls where it's the horse is definitely out of the barn. We get calls from agents where they have clients who are trying to get long-term care insurance but are automatic declines. We are getting calls from people who are going on to claim. We are getting calls after practitioners are doing seminars, publishing articles and papers. As they spread the word, as you're out talking to those people most likely to want to use your services as an advisor, those are people that are likely to still be in a position where they own a life insurance policy, and that's important to point out. They need to own an in-force life insurance policy. Now, we rescued policies that were in grace. We've even seen policies that have lapsed be reinstated, but there needs to be a life insurance policy in place to use our solution, and people that will be out to and looking to secure and work with a professional advisor such as an elder law attorney or other types of professional advisors are those that would have a higher likelihood of having planned and still have a life insurance policy. Those that did buy long-term care insurance or other financial vehicles preparing for the future are a higher likelihood of candidate to have a life insurance policy. So obviously, there's a lot of outreach that's done by us and those we work with into the assisted living communities, the nursing homes, the home care companies. We have a network that work with us of approaching 7,000 around the United States. Insurance professionals, legal professionals in the thousands are also working with us across the country. And these are the places where they're finding opportunities to help families that are looking for solutions to how are they going to pay for care. So I want to shift into answering questions, and I see people have been starting to submit them, so I'm going to start to go through them, and I'm going to call them out as to whether, Randy, I think you want to address it or me, and this first one I think is for you because it's addressing specifically your first example. And for your first example with the client you work with, their question is, why was it important to delay the inception of Medicaid benefits for that person?
Well, because when I put my client on Medicaid and when I have the land as income producing, then we're going to have a lien against that land for that Medicaid benefit. And so obviously in this particular case, we got rid of 17 months, at least 17 months of Medicaid liens. It, you know, and it just really made a lot of sense in that case because we just avoid it. And plus the other thing, to be honest with you, is she wanted to be able to keep her mother in a private room. Once she went on Medicaid, we were going to have to move her just as a policy of that nursing home into a semi-private room.
So this was a circumstance where a term life insurance policy that had a high likelihood of actually being lapsed, you were able to preserve and delay the need to do anything with other assets and keep them private pay and allow them to choose the form of care and the location of care that they wanted.
And in fact, Chris, they had already missed the payment, and I said, make the payment so we can talk. And so they were, 4 or 5 days past the payment time, and so we got them going and got the family in here. But yep, absolutely. I mean,
yep,
it was a great solution for the folks.
Somebody recently referred to the dollars that are produced by using the life care funding approach as soft dollars versus hard dollars, cash, real estate, other assets. You're liquidating a life insurance policy with a high likelihood of lapse or surrender to access sort of found money or soft money, and delaying or even sometimes outright preventing your need to access hard dollar, hard asset, hard cash, and using this soft dollar approach. Second question I think I can address. If there's a balance in the account, does the beneficiary receive the balance plus the final expense amount? Yes. The final expense portion that's held in each account to the end would be included in a payout of a balance, because that would happen after somebody would have passed away. So the entire amount in the account is paid out to whoever's been named as the account beneficiary. Let's see, next question. It appears that a primary consideration is the health condition of the proposed covered individual, such that the health condition almost precludes consideration of other, more leveraged financial options. Is this correct? I'm not exactly sure what you're getting at with this question, but I'm going to say this, that yes, the health condition is very important, because what we are determining through the analysis of their health condition and through the analysis of the policy itself is not only what their need for care is and what the monthly cost for care is going to be, but we are determining what the remaining potential life expectancy of that person is, because life care funding is purchasing the life insurance policy. We are taking over the premium payments. That is no longer something that the family is required to pay for. So we need to understand, as we value the policy, as we come to what its present day value is, to be able to fund their benefit account, we have to figure out, is this a policy that we'll be paying premiums on for 2 years, for 5 years? What is the time frame that we will be carrying this policy? What are the costs involved? And that obviously becomes a factor. So the bottom line truth is, the sicker somebody is, the more they're going to get for the conversion value of their policy. Somebody with a life expectancy in the 1 to 2 year range is going to get something closer to the 50-60% range of what we pay somebody whose life expectancy might be pushing 4 or 5 years. If a variable policy is involved, do we need to be a registered rep, i.e. FINRA licensed? That would be the case certainly if you are going to be receiving some form of commissions or remuneration for having facilitated the enrollment into the transaction. I can tell you that working with variable policies certainly does bring an extra layer of complication and licensing requirements. Other appropriately licensed third parties have to be involved in the transaction that are not involved in life insurance policies that are term life, universal life, whole life. Those, any variable, any fixed or fixed policies or temporary policies are more straightforward and easy to work with than a variable, but we have worked with variable, and that is something that we will take a look at. But licensing is a consideration when doing so. Is life care approved in New York State? Yes, life care is approved in all 50 states. We conform with insurance regulation in all states, and because the policy ownership is transferred for a sum that is less than the full death benefit, we conform with life settlement regulations in each state, although life care funding itself is not a life settlement company. We're scrolling down to the next question. Before, one of the primary requirements was either already receiving or will be receiving LTC. Is this still the case? Yes. It is important to qualify for this program that somebody has a relatively immediate need for care, which we tend to look to be in a range of today to maybe 90 days out. Certainly something that is well within, you can see, less than 6 months, and typically people that are enrolling in this program, once the account is funded, the funds are being used towards care immediately. It's very rare that the funds would sit unused even for 2 or 3 months. It's typically used right off the bat. The minimum policy size is $50,000. May multiple life insurance policies be pulled together to, no, it has to be one individual policy at $50,000. You could not combine two $25,000 policies to be $50,000, because each policy has to be dealt with on an individual basis. So each policy has to be a minimum of $50,000. If the policy is large, will LCF buy part by effectively buying 100% and allow the family to be named as a... There are ways to work with larger policies, and sometimes there are restrictions in the contracts in terms of doing a split benefit, but certainly a larger policy, and I would say the range of policies that Life Care Funding typically sees is between $100,000 and $500,000 of death benefit. Something in excess of $500,000 we see less frequently, and something that's above, say, $750,000 to 7 figures and above is even rarer still. That being said, yes, there's flexibility, and we're always open to figuring out what is in the best interest of the family to come up with a solution to address their long-term care needs. And if a policy is particularly large, there might be ways to find enough funding out of the policy to handle their needs and still having and not needing to use the entire policy. Do we need to be licensed or registered as a life settlement agent in our state? If you are operating as an insurance practitioner, a licensed insurance practitioner, you need a life license and a life settlement broker's license in pushing 45 states. Every state regulates differently. If you are an attorney, a CPA, or a licensed financial professional such as a CFP, for example, there are exemptions to life settlement licensing because you are put in a position that you are able to bill your clients directly, and in so doing, the client can instruct the benefit account to pay the fee. So for example, an attorney, if they so choose, can bill their client directly for a percentage, for either a fixed amount or a percentage of the death benefit in the form of a contingency fee that the benefit account, once funded, would pay to the attorney. So if you said to your client, I'm going to receive a 3% of death benefit contingency fee if we successfully enroll you in this, and if not, I will receive nothing, the account would pay you, once funded, a $3,000 fee on the $100,000 policy, because that would be an agreement between you and your client, the client, and there are forms that are already in place to make sure those instructions are done correctly for the account to pay that fee to you. So if you're a licensed life insurance practitioner, you need the appropriate licensing to receive commissions, but if you are an exempt class of advisor, an attorney, a CPA, a CFP, you are able to bill your client directly with the account paying you. A further question to clarify life settlement licensing: if you have a life insurance broker's license or agent's license in your state, you would need to go to your state insurance department, typically on the website in the licensing area, to look up life settlement broker's licensing, and typically that would be filling out a form and paying a license fee to the state to obtain the life settlement broker's license that you would have on top of your life insurance license. A good question here: is there a 2ADL requirement to be able to access the benefits, such as there might be with long-term care insurance? And the answer is no, because the underwriting for this program is done on a geriatric clinical basis. So each case is looked at uniquely with geriatric underwriting professionals reviewing the situation, looking at medical records, talking to the care practitioner to get a real handle on the situation, and from that determine what we think we're working with when it comes to the family and valuing the policy. We know that there are circumstances such as Parkinson's, such as Alzheimer's, where the ADLs may not be there yet, but there are clear indicators of where the disease has progressed and what the remaining life expectancy should be. So it is a more specific and clinical approach to the review and underwriting. There are no meds, there's no parameds, nobody's going to draw blood from anybody. It's a review of medical records, it's phone interviews, it's analysis to understand the geriatric situation, the familial situation, the environmental situation, and from that, a determination of what we think the life expectancy would be. ADLs are a factor, but they're not a prerequisite. Next question as I scroll down. You know, this is an interesting question. Can you discuss the rules that prohibit carriers from beating up agents for selling policies? It's an interesting question. You know, for a long time, insurance carriers have had a negative view of the sale of life insurance policies in the secondary market in this way. And it's primarily been driven by the fact that that eats into their profits. It is much more profitable for an insurance company to have collected premiums for 20 years from somebody who lapses their policy than who would have sold off the policy to an entity such as us, who will keep the policy in force and collect the death benefit. This is becoming a very interesting legal discussion, and precedents are starting to be established around the country through court action, where families have sued advisors, have sued insurance carriers for preventing them from information about these kinds of options that would help them. And our advice has always been to agents and advisors that you, in a fiduciary position, should be informing families of everything and anything that could potentially help them pay for care. You don't want somebody coming back to you later saying you withheld information from me that made a material difference to how I ultimately ended up in what we were able to do for taking care of myself or a loved one. It is an ongoing debate that probably won't ever really be settled, and it really becomes a matter of the agent themselves making the determination of what's right, what's wrong, what really is a fiduciary responsibility, and if they know that there's something there that can help a family, are they going to tell them or not? And there is more and more precedent being established around the country in favor of the agent doing the right thing, telling people about what their options are versus not. Can an annuity or structured settlement be converted in the same way? No, this is only going to work for life insurance policies. Another question, will these qualify for state partnership toward Medicaid spend downs? Yes, these will. This approach is recognized as a Medicaid qualified spend down, and state partnerships recognize it in the same way, as does the Veterans Administration in conjunction with VA aid and attendance benefits. And that is the last question that came in, so I'm going to offer to everybody on today's session that we will follow up with you and send out a copy of the PowerPoint to you with additional information. We are always standing by ready to answer your questions. Looking forward to working with you, helping families. It's our pleasure to have you join us today. We will be following up, and I do want to end by first and foremost thanking Randy for your time and joining us today. And before I fully conclude, Randy, if there's anything else you want to please chime in. But I will say this: if you look at your clients, if you look at your referral sources, I guarantee you that on this call, and we had about 80 people on today's call, and among those folks, There are people right now that have clients or have relationships where there's somebody struggling with how they're going to pay for care. They have a life insurance policy, but they don't know this is something they can do. And when they find out that this is something they can do, it's pretty intuitive. It moves. It can move quickly. It's not heavy lifting for the family or you as the practitioner to access this as an option. And it's just a matter of getting the word out, keeping your eyes open, remembering that this is something to add to your toolbox, and that Life Care Funding is standing by ready to help. Randy, thank you so much. I don't know if you want to close with any final thoughts yourself.
No, I just think it's a great topic to be aware of and to talk with your clients about. I just think it's almost mandatory that we be aware of this.
Randy, thank you so much for joining us today and sharing your experience. And ladies and gentlemen, thank you for joining us, and look for us to be following up with you via email with more information, including today's PowerPoint that you'll be able to hang on to. And never hesitate to reach out to us by phone or email. We look forward to supporting you and working with you in any opportunities that we have. Thank you all so very much.
Thanks, Chris.